So here we have a company, and this company has a relationship with a shareholder. So John Doe Trust holds the shares, and what we're going to do is we're going to prepare a set of accounts and a tax return. Now let me just delete out the previous set of data, so we're starting from scratch. So Edwards & Co has revenues, it has tax of 30 cents on the dollar, so it's not a base rate entity, and it paid 10,000 in dividends, and its tax liability is 20,000 because it had a $10,000 tax installment that it paid during the year. Double check your classifications and then get to work on the tax form. Let's take that tax form out, so we're starting from scratch. Noting there's depreciation in here, which we're going to take out. So just the depreciation is coming in because it has previous examples with depreciation, but for this case I want to make it simple. So we're just purely focused on the dividend and the profits flowing accordingly. So none of these are applicable. And for the example, I'm just removing them. So you can see it's 100,000. It's saying 25,000 taxable income, which is wrong because it's defaulted to a base rate. But now you can see it's 30. And also notice in the settings, I have disabled small business entity, which changes the way the share register will calculate the franked dividend. So we're paying a dividend of 10,000, which you saw in the accounts there, to fully franked, and it's going to be paid at 30/6/2024. And we need a class of shares, so we're paying on the ordinary class, right? So that we will apply. So you get the 4285, which is the credit, and if we have a look in the franking account now, there's the debit, and the form should have updated. So the tax calc is 30. We need to recognize the 10,000 in the credit. So this is $10,000 worth of tax installments paid during the year. So now that 10 or the 20,000 liability matches with what we've got in the accounts. So it's a 20,000 liability balance, but the tax is still 30,000 on the 100,000 taxable income. And at the form level, you can see that dividend has now been processed through, and so have the values for the franking account. So there's the John Doe Trust receiving 10 with a grossed up amount, and we've got our franking account transactions reflected. Now we can head over to the form and the accounts for the trust, and in this case the trust is receiving that 10,000 dividend. So this is number 6. Let's just import that. So import the set of accounts into the trust. Let me take out the previous example. Check the relationships. So we've got Edwards & Co as the shareholder. Import that set of accounts. Double check your classifications. And let's go and make the form. So this trust is essentially going to be an interposed entity because this trust has a shareholder has a beneficiary, which is another company. So we've got 10,000 plus the grossed up. So it grosses up with the franking credit, and in the reconciliation, the accounting profit gets removed, and so that's the accounting profit getting removed and the taxable income getting included, which will then go to the beneficiary, which in this case is the Doe Pty Limited. Now this is getting 100%. We need a trust assessment code here. So I think it is resident beneficiary 34. So you can see it's the grossed up 14,286 with tax of 4,286, and the tax return, when this flows through to the other company taxable income, we should have a tax. Well, here you can see, let's have a look at what's flowed in here. So it's got a frank distribution and it's got the franking credits, so those have flowed through, and there's no tax because of course the flow through means that the franked or franking credits completely cover the taxable income. So that's your flow through. Now if we wanted to produce the accounts, very quickly produce a set of accounts here. I'll remove my last example and let's put in a set of accounts for this John Doe Trust. So financial statements, and that's the 2024 year. I've got no comparatives in here. It's just the 1 year that we've reflected. So if you don't want to see the comparatives in there, which there isn't any, why can we not see? So we should see the ability to go to 0 years. Okay, so what we're seeing here, we don't need a cash flow. We're seeing the comprehensive income, which is just the dividend, the money left in the bank account, the settled sum, which is the retained balance matching the cash on hand, because the beneficiaries haven't received the taxable income. And of course, John Doe the Doe Trust did receive that, or Doe Pty Limited did receive that dividend flow through from the trust. So it's really a trust distribution. And the way that we would position this is just with the one balance and no drawings, so that sits there as the balance on the balance sheet. And that's the full flow through, noting of course that I haven't yet prepared a set of accounts in here, which would once again just have trust distribution income, the accounting income of just 10,000, and whatever the balance sheet is as a result. But you can see the taxable income is the grossed up amount, and again, because there's enough franking credits, there's no tax payable.